Hey everyone. What's what's up? Thank you for tuning in. Thank you for waiting if you've been waiting on the YouTube live stream. And for you guys on the Zoom link, welcome to our webinar on valuations, man. We get the question about I'm sorry, the answer about how to value a startup early stage is so counterintuitive that um that it kind of deserves a whole webinar, I suppose. So that's why we do this. We're gonna have a bunch of time for questions. I have a few slides on valuation, but happy to kind of answer. And we've gone through a couple of funding rounds ourselves. We've helped a bunch of companies do it. So yeah, like we I guess we've been in the hoops for a little bit. So let me share my screen again and kick it off. So the first thing I'll say is, or the first question I tend to get is this, do we have a recording of this? Do you get access to the slides? This has been live streamed on our Startup Club channel, which you should check out. We have a bunch of more eloquent versions of this webinar where we actually have cuts and edits and explainers, not just slides. If you're looking to navigate or figure out how this stuff works, if you're in the live stream, then you're in the right channel. If you're on the in the Zoom webinar, then that's where you can visit and get hit on this, and of course watch the recording of today's webinar. We're doing live webinars every week, by the way. So we have another one coming up next week, and the week after. I think next week is on Tuesday. So yeah, bunch of topics that we'll be covering live, bunch of time for questions, etc. Okay. Now the only reason why we know how to do this is because SlideBean is not just a YouTube channel. We have a platform for founders to navigate fundraising. We've been doing this for 13 years now. And that's the question, right? You have this idea, it has the potential to become a $1 billion company. So how much is it worth now, right? How much is that idea worth today? If in the future it's going to be worth billions, right? How do we leverage, how do we bridge this thing, such a valuable idea for the future, right? So I think that the first thing that we want to understand about valuations is that it's an agreement, right? We have to agree, a group of founders and a group of investors, they have to agree on, yes, how much this company's worth, but they have to sort of align what their interests are. And what are their interests, right? What are founders and investors' interests? Talking to a lot of founders, I've seen, for example, percentages, right? It's, oh yeah, like I wanna keep 51% of my company because I saw that in some Hollywood flick. It's like, yeah, if you lose 51%, you're doomed, right? So like that's stuff that I think founders put a lot of thought into it. So that's one. Another potential kind of horror story, I think, also fed by Hollywood is not getting fired, right? So it's hey, like I don't want to lose control of my company. I don't want to get fired from my own business, right? That sucks. And we've seen that story a lot. Those stories tend to make headlines. Salary, right? That's another factor, right? How much am I going to pay myself? And maybe in the future, net worth, right? How much money am I going to make from this business? Or am I going to be able to make a living from this company, right? Those are kind of like founder questions. But the stuff that founders think that investors want are different, right? A lot of founders think that investors are into control, right? They want to control the company. And of course they want ROI, right? They want a return on their investment. And again, the bridge that connects all of these things, right? The interests from the founders and the interests from the investors, that is evaluation, right? How much is the business worth, right? That we're putting a price on something, and that we're obviously balancing these two things. But I think that the first misconception about this whole ordeal is that VC backed startups, they're not about control. Investors don't want to control the business. That their investors are very bad at running businesses. That's why they invest in companies instead of running businesses themselves. Um, so let's go through a scenario, right? Like let's imagine this scenario of company one. Let's imagine in your head you think of yourself as this business, right? And you're looking to raise money for your startup. We are all here before funding, right? And funding is, we're trying to raise this first round of funding. We're trying to figure out what this valuation is. And in this company one journey, again, where are we headed? Where is this company going? We want, of course, to succeed, right? And that success maybe comes in the form of profit, right? That, of course, right? A business needs to make profits, right? And so how does that align to the stuff that we thought about, right? It aligns with percentages. Yes, we want to keep control of this company. We don't want to get fired from it. We want to collect on those profits. We want our salary. We want our living. We want our net worth from this business. But let me paint you a different type of business, because these are two very different types of businesses that I think founders oftentimes just uh, um, just mix up, right? By the way, if a question comes up in the middle, I have chats here for YouTube and for Zoom. I see you, Andre. Hey, yeah. So if you have questions, just throw them in there. I'm happy to stop for a sec if it's relevant to what we're talking about. Hopefully, there's a slide for your question already, so we maybe we'll talk about it, or I'll say that anyway. Company one. So company two. Let's go to company two. What is company two? Company two is more like maybe your typical TechCrunch sort of venture or tech funded startup, right? We're here again. We're here before funding, but this company is going to go through a bunch of rounds of funding, right? It needs to raise a lot of money. Why? Because this company is not looking for profits. And that's the big difference, right? Company two is not prioritizing profits. They want to succeed, but succeed doesn't only come from profits in this world. Succeed may come from selling your business, right? So success for this business is not profits. It's not, collecting, I don't know, dividends for the business and paying them out to shareholders at the end of the year. Some businesses do that. Some really good, successful businesses do that. But most tech companies, that's not the game that they're playing. They're normally, most of the time, 90% of the time, they're playing the game of exit, right? There's a buyer in their minds, a larger company that really benefits from this technology that will buy them out, buy out all the shareholders, and that's how this company will make money. So all this percentage fuzz, right? This caring about percentage doesn't really matter. What really matters here is a payout, right? How much am I going to be paid when this business sells? And then the other case, the other 10%, which is IPOs, right? The business might go public, which again, stocks are getting traded in the public markets. They're being sold, and there's a payout for everybody, or at least this imaginary thing, which is a share of stock, like becomes tangible, right? There's a cash value to it. And so that's the other option. But profits are not so exciting for company type two. I see you, Salim. What's up? Thanks for tuning in from India. I don't know what time, 10 p.m. I'm assuming. So thanks for staying late. Okay. Now here's the big difference. The big difference here is company two is the typical VC company, right? We've seen it. We've heard about it. We've seen those companies raise a lot of money. That company can definitely raise venture capital. That's what investors are chasing. Now, the thing is, company one cannot. Company one cannot raise venture capital because that case where there's only one round of funding and this company looks for profits, and it's going to take, it would take for this investor many years to recoup their investment. And so there are investors for company one. They're just not VCs. Venture capital absolutely chases company two. Very fast growth, exit. That's the path of success, right, for this type company two. So a lot of what I'm going to be talking about is type company two. Type company one or company type one exists. Again, normally the investor that funds this company is probably like a partner to the founder. It's like a 50-50 thing where both of them, where both of them kind of share a company have. One of them is providing the capital, the other one is kind of working. That's usually the way company type one works. But company type two, again, the typical startup that you will read about is what we're focusing on today. So let's keep going. So we've established that what we really care about in this company type two is the payout, right? It's how much money we're going to make. So that makes other things less important, right? Like percentages, right? What do we care about percentages if what we care is how much money we're making? And I'll give you this example, right? Let's say that you build a company, right? You raise some money and you launch this business, and you make this company grow to a company that sells for $10 million, right? And because you were very careful with funding and you didn't want to get a lot of investors in, and you were very conservative, you still own a big percentage, a big chunk of this business. So you own 40% of this company, which means that when this company sells, you're going to make $4 million, which is, I mean, it's transformative money by any means. It's a lot of money, $4 million. But let me give you another case. Let's say that you go in this really crazy growth path. You grow this business like crazy, and you hit unicorn valuation, and somebody's willing to pay to buy you out for that unicorn valuation. Now, in order to do this, you had to go through a lot of funding rounds. You had to raise a lot of money. You had to go through a lot of investors. It was a lot of pain. But you quickly reach these billion-dollar valuation, whatnot. At this point, maybe you had to get so many investors in order to fund this business that was unprofitable for so long and that spent so aggressively that you're only left as a founder with a 4% stake in the company. Well, that's $40 million. So, what game are you playing, right? As a founder, right? Are you playing company one or are you playing company two? Again, company one can be sold, can raise money. Like there are investors that are more traditional, that look for bigger stakes in this business, in these businesses, of course, right? If you're investing in a company type one, you need a big chunk of the company in order to make an ROI, right? If this company once needs to raise $1 million, and it sells for 10, this investor is gonna get I don't know, 60. I mean 60% of the company, so $6 million. That's a great ROI, but it's not what we're seeing in company two, right? And that's the game that a lot of investors want to play. Now, here's an extra twist to the way you're thinking about these valuations. This chart, I don't think that I had any chart like this when I was starting Slidebean. So like this is like a new information dump, but I think useful. This is the amount of equity that the typical group of founders has or owns at different funding rounds. So look at that priced seed here at the top. The median. So this is the black dot is the median. So the median founder at their priced seed, the median, sorry, group of founders, all founders combined, have 56% of the company. Say again, all the founders, maybe there are three founders in this business, three founders combined, by the time they raise their priced seed round, or their first seed round that has an actual valuation, they own a total of 56% of the business. That's what, 2018? I'm sorry, 18% each, maybe something like that. Yeah, something like 18, 19%. Okay, I don't know if like that, does that blow your mind? I don't know. Let me know in the chats. Is that a lot less than you expected, right? Two founders, each of them would own 25, 27% of the company. At price seed, right? So that's the median, right? By Series A, the median group of founders owns 36. I see you hands with less than I expected. I know. And these are, again, this is the median, right? This is not founders getting screwed or anything. This is just like the typical case, right? Median case, 36% for all founders combined. So three founders, that'd be 12% each. At Series B, if some top companies, right? This is the top percentile of companies, the top 10% of companies, they still own majority control, right? They're still over that 50% by Series A. But by Series B, no group of founders, look, there's no company that raises a Series B where the founders have control of the company. It's not a thing anymore. Why? Again, because again, as the business scales, the only way to raise capital so aggressively is by shedding control or percentage of the company. And percentage is not control. And we're gonna go to that in a sec. I see you. Question in game two. What if you failed the next round? You either shut down or fire. Yeah, that's the thing, right? The problem with company two, of course, is that if you run out of money, your company dies, right? I think if I were to add something to this, I think that a lot of us founders kind of set up to build like company two. If you set out to build company two and your company is not working, right? And your company is struggling and you can't raise the next round. Normally you can't raise the next round because you haven't reached the big milestone or the company's not exciting enough or you're not generating enough revenue, right? Something's not working and therefore you can't raise the next round. I think it begs a real question of, hey, do you still want to work in this business, right? I've worked or started Slidebean 13 years ago. It's been 13 years of my life, which is a long time to work for a single company. I think there is a world where, if the company hasn't become what you expected it to become, it's fair to, as ugly as it sounds, let it die, right? And just start something else, right? Look at the day and age where we're living today with OpenClaw and vibe coding and the stuff that you can do. Like you can build a product in weeks, not months, not years, right? You can build a SaaS product in days now. And the question is, I mean, do you want do you want to kind of dedicate your life to this one thing that's kind of working and flaky and or not, or do you want to do something else, right? And I think failure in startups is over feared failure. Failure is not as bad as I think people think. Um, yeah. I see more questions. Hold on. What about not giving control percentages? I'm going to get to this in a sec. Is it still possible to IPO after raising Series B with dual class shares to retain control? I mean, you'd need to be a pretty big Series B company to IPO. Look at the IPOs that we're seeing now, right? Normally, companies already in the billions of valuation. Usually, you don't get $2 billion valuations by Series B. Usually, there are a couple exceptions, but yeah. Watt is telling us their share. They're holding 83% pre-seed. Most of the rest is currently pooled. 2.5% is going to the accelerator. I mean, that's good. 83% pre-seed, that's good. There's another round coming, I mean, to the comparison, right? So as you raise another round, which might be maybe 20% for the investors, that leaves all the founders at 63, and you start a stock option pool, which you would need to do another stock option pool with the new round, and that puts you at 56. So it feels like you're kind of in the typical path, right? The founder's share slide, is it not a little too aggressive in favor of third parties? That's why I put this slide, Andre and everyone. It is aggressive, but it is what it is, right? It's not a forecast or anything. It's just like the facts. This is facts, data from 2025, right? So that's just what it is. And then again, a lot of founders, I've seen a lot of founders kind of blow funding conversations because they don't want to get diluted so much when maybe the deal that the investors are offering is not crazy, right? It's within the standards, right? How does a company get traction? That's a much bigger question. We'll get to the bigger questions. Let me go through the slides on valuation. Okay. Um, so we established valuation. And now with that slide, hopefully we've understood that majority ownership is not something that we can aspire to as founders, right? The majority ownership is a bit of a fugazi. It's a bit of a Hollywood thing. And the reality is that by Series A, we probably won't have majority ownership, period, right? I've seen founders fight within themselves, right? For example, I've seen two founders, right? One of them is like dead set on their 51%, and they get 70% of the company. The other founder gets only 30, and then the way this 70% founder, what they're thinking is, oh, when funding comes in, I'm still gonna own 51, right? Like I've seen people make a mess out of this whole ordeal. If you're a company too, you're not looking for that majority ownership, right? What you really want in the end, right, is I think sharing your decision making with smart people, right? These theocracy or monarchy companies where there's one person that just has the final word, I think they're very risky. I wouldn't want to work for a company like that where there's one founder that has absolute control. Their decisions define everything. There's nobody that can question them. There's no board. There's no group of people there's no other co-founder that can agree on things, right? I kind of, I think that we were a team of three co-founders, and every step of the way, like I respected their opinions very much, and that's a relationship that it's very hard to create with an employee, right? There's always this authority, but when you're all co-founders, and when someone says, "Dude, what you're saying is idiotic. We should not do that." It's like, oh man, maybe that guy's right, right? So you want somebody that can question you, and when you see these like monarchy companies that a founder that doesn't want to share that decision making, I think that's usually a bit of a flag. Um, Right. And at the same time, right, on the other end of the investors, like they're not looking to remove the founder, right? That's not what, I mean, you hear these horror stories, but that's not what they want, right? It's very risky for a company and for the investors and their money that's baked into this company. It's very risky for an investor to remove the founder. Like what they do want to protect is they don't want the company going under because someone is being an idiot, right? They don't want the company that there's to be some human error in the company that breaks it, right? Because this founder just suddenly became idiotic or did something inappropriate, right? So they want some control or some not control. Control is the wrong word. Uh, Leverage, some opinions, right? They want decisions to be made as a group of smart people, right? And that's honestly what the board is for. That's not what the valuation is for. That is very much the purpose of a board of directors, right? A board of directors makes decisions for the company. It's usually, I mean, it starts with three or with five people, some odd number, so that somebody can break a vote. And people agree or disagree, and they discuss. And if you put someone on the board, it's because you trust them, you think they're smart, and if they, if the group, if the board decides that the founder needs to stop doing this, it's like, well, maybe you should listen to them, right? So, um, I think that that's an important distinction, right? Valuation and percentage ownerships does not define decision making in the business. That's the job of the board, which is not the topic of today's webinar. We can talk a little bit about it. Okay, so um, let's get back to how much, right? So we've established that this is an idea to $1 billion company, right? And how much is it worth? How much is it worth through all these rounds of funding? And we've also established that we have a bunch of rounds of funding, right? If you're company type two, we went from pre-seed to Series B, et cetera, and eventually we're leading towards that exit, IPO, payout, whatever you want to call it. Okay, so we can talk a little bit about milestones, right? In a standard tech company in this day and age, there are some milestones, right? We said idea stage. Idea companies are not fundable, period. An idea stage company is not fundable, period. Again, if you just have an idea, you can't go over and raise money for it. You need to reach at least pre-seed stage, which is more than an idea. Pre-seed stage is a team. Pre-seed stage is mock-ups. Pre-seed stage is maybe a draft of your product. Maybe you can code it. You can vibe code now, so you can start with some prototyping, right? So customer conversations, right? A pre-seed company needs to have existed for a few weeks, for a few months, I would say, as the founders have been thinking about it and figuring stuff out, planning, right? Even though it's not revenue. Revenue starts somewhere between pre-seed and seed. Pre-seed is not MVP. Also, Anthony, I wouldn't say that. I mean, I think that we're moving towards that where building products is so cheap now, or so quick, so cheap because you can automate part of the work, right? It's getting to a point where it's so cheap that there's more expectations to what a pre-seed company might be. But yeah, like MVP, I think people mix up MVP a little bit. It's like, was it something that works, that's launched, right? I think that you should not try to launch if you don't have the money to launch, right? So you should still raise money far before you launch this product, because we're going to talk about it in a sec. But anyway, pre-seed and seed, somewhere in the middle is when you launch, when you start generating revenue. A seed round you would raise today when you hit somewhere in the 40K in monthly revenue. I'd say that's a good benchmark for a seed round. So this is by all means 40K a month. That's the running business, right? That's a business that works, exists, is growing, etc. And then Series A is something that you raise when you hit about $2 million in annual run rate. So your first million in annual revenue happens somewhere between seed and Series A. Okay, so there's with these milestones that we've set up, right, that we've established, one thing that we know is that, well, there is a line between seed and Series A, which says like, well, sorry, yeah, but if a seed round is raised when there are 40K in monthly revenue, right? That means that after that point, we could maybe value the company based on revenue, right? Because if you have a seed, if a company that raises seed has revenue, that means that the valuation of this business could be dictated by some multiplier of that revenue, right? And that's a thing, right? Maybe you've seen that companies get valued at maybe 5 times ARR, right? And that happens at some point after there's revenue, right? But what happens before there's any revenue? What do we base valuations on before that? Is it based maybe on forecasts of this business, right? But again, Shanti, pre-seed is pre-revenue, right? So that yellow line here in the slide. Anything before the yellow line, you don't have any revenue at this point, right? Or very little. Pre-seed you raise pre-launch normally. So again, yellow line. After the yellow line, there's revenue. We can calculate a valuation. We can use numbers and math to multiply something by something and get a valuation number, right? But how about before, right? How about before there's revenue? How do we evaluate, right? Oh, typical answer. It's like, well, but this is a billion-dollar company, right? I've run some forecasts. I've run the math. This idea that I have, this pre-seed business, it's on a path to $1 billion valuation. So my valuation today is dictated by my future $1 billion expectations. Well, guess what? Every company every company type 2 has that story. Every company type 2 is in theory, $1 billion company. Might or might not happen, Most of the time, it doesn't, right? So like that doesn't make you different or special. That valuation or that sort of that forecast at early stage that you're going to be some billion-dollar business, it doesn't have any weight on your company against other companies, right? Because all of them are sort of telling the same story to the same investors, right? So it's not that, right? What else could we use to value a company? Growth. Growth is an option, right? Growth is by all means an option. We can estimate the value of a company based on its growth because again, when we have when we have I mean somewhere between pre-seed and seed, that's when the company launches, right? That's when the company starts generating revenue. So the growth, how fast this company is growing, that is something that we have before the yellow line and definitely after the yellow line. So that's of course a big that has a big impact in valuation. The other part is and a bit of to the question that came up earlier. The other part is FOMO, right? I think a lot of rounds of funding are raised, or if not all rounds of funding are raised with some component of FOMO, fear of missing out, right? And for the investors, this is something like this, right? I need to invest. You need to kind of send this message or like transmit this message to the investors that you're talking about. You need to invest in this business before it's too late, right? Before this business blows up. But let's remember, like, what do investors care about, right? They're everybody's looking for the payout, right? So we can maybe rephrase this a little bit. We can turn that phrase into, I need to invest before my payout is too small. That is the FOMO that you have to transmit, right? What the FOMO that you need to transmit to an investor is, this company is about to fucking blow up, and if it doesn't, and if you don't get in now, you are gonna miss out. Like that is the feeling that you sort of have to translate, right? And that gets, that is sometimes easier, sometimes much harder, right? I want to zoom in a little bit into this section, right? Into the pre-seed and seed, because at pre-seed, how do you talk about FOMO, right? At pre-seed, FOMO is like, we're this insane team, we're really experienced, we're really passionate. This business, this opportunity is booming. We've discovered something in the market that nobody else has, and if we don't build it now, we will miss out. So you can get in with us. We are one step ahead because we figure this out. We have a better product and we have better ideas and we have more experience than the next guy. And we're going to execute this so fast that we're going to own this market. And if you don't get in now, like, we'll miss this opportunity. That's FOMO without revenue, right? And you can kind of portray that message, right? Let's take seed, for example. Like the seed company, we said about 40K in monthly revenue for a seed company. So how do you create FOMO for a seed company? Well, this company launched, it's growing, it's making 40K a month in revenue. 2 months ago, it was 20K. So it's basically doubled in size in 2 months. If you don't invest now, like, this company is going to the moon, with or without you, is kind of like the message. It's going with or without you, but you have the chance to get in now. And that's a great opportunity because the valuation is lower because we're just pre-seed. If you don't decide to invest now, fine. Maybe you want to wait a little bit and you want to be sure that we're on the right path. So it's okay. Let's. If you wait for 6 months, our valuation is going to be doubled. So your payout's going to be half. That's a FOMO that you can translate to investors when you're in these two stages. And I think that's why raising money at pre-seed and like why those sort of characteristics for a company makes them very fundable at pre-seed and seed. Worst possible position you can be in if you wanna raise money in terms of FOMO, you build an MVP, it's ready to launch, and you go to the investors and say, "Hey, we've built this MVP, we've built this amazing product. It's ready. We're ready to launch it. It's such an amazing product. It's going to grow like crazy, and yeah, we're just raising funding to launch." To that, the investor might say, "Okay," and I'm not an investor, but I would do this. I'd say, "Cool. I'm really excited about what you guys are building. I'm traveling for the next couple weeks. But let's connect maybe 3 weeks from now and you tell me how things are going and we'll connect again." Right? So what am I doing? I'm not saying no. I'm just stalling as an investor, imaginary investor. And so what happens after 3 weeks, like 3 weeks is a lifetime in a startup's life, right? 3 weeks is anything could happen in 3 weeks. And so we talk 3 weeks later, and it's like, well, how much have you grown? It's like, well, no, we haven't grown anything. We have the product's ready, but it's not growing, or maybe we did a soft launch. And well, okay, but how much revenue do you have? How was adoption? It's like, oh, well, we have some beta users and so on. It's like, okay, so that maybe the product wasn't as exciting as I thought. Okay, I'll pass. So that's kind of a really bad position to be in for FOMO at launch, just launched, or right before launching. Why? Because investors can wait and see. There is not a lot of FOMO that you can create at launch, right? Because if the launch goes bust, then the investor knows how it went, and that's it. If the launch goes great, then well, yeah, maybe you're still not going to have a lot of revenue, right? If the launch went amazing, and 1 month later maybe you have 10K, you still have a good opportunity. You can still get into this business if you want. It's you're investing before seed, right? So there's not a lot of FOMO. There's not a lot of reasons for an investor to put in money just before something launches. It's 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 too risky, right? And more importantly, the answer to the question of whether this business will make it or not, the answer to that question is about to come, right? It's almost here. It's weeks away, right? When you're pre-seed and you're months away from building this product and launching, it's like, okay, like yeah, if I wait, I'll miss out. And when you're seed, things are moving really fast. So if you don't invest now, like the valuation will double, right? So like that's kind of where we're heading. So I'll give you the answer that you came all here for. I mean, hopefully I've taught you a couple things or two about how this works, but I'll give you this answer. The standard valuation for a pre-seed company in 2024, so 2025, sorry, 2025 was the standard pre-seed round was $900,000 raised at a 7.1 million valuation. That's the standard. That's the median. Just like I gave you the chart with the percentages, this is it. This is based on Carta and PitchBook data. Seed valuations in this day and age, in this ecosystem, $3.6 million raised. That's the median seed round that companies are raising. These are huge rounds by all means at a 15.1 million valuation. That's it. That's the answer. That's the standard. That's the standard. But hopefully now you understand a little bit why, which is it's not because the company um, um, sorry, lost my train of thought. It's not because the company has some multiplier forecast financial model that's using as a multiplier. No, especially at pre-seed, there's no revenue, right? There's no data. Every company is $1 billion story. The difference is, it's just a standard where investors can agree on this number, and if this is the standard, you can skew away or close or away from this number, and from that you can decide, right? If you suddenly want to going to raise $900,000 at a $12 million valuation, it's like, why are you worth almost twice as your next guy? What's going on? Like, why, right? And again, establishing the fact that everybody's $1 billion idea at this point. With seed, maybe you can justify it a little bit. Maybe you have extra revenue compared to the next guy. Um, Maybe you have some really good technology or some faster growth, right? That way you can justify it a little bit better. But again, the typical seed company is making 40K a month in revenue. It's growing maybe 20% every month, right? So like those standards are really set up. Now, the next thing I want to do is I want to show you how this actually looks. Like I want to show you how it looks in an actual cap table. So I'm going to use the cap table that's in our platform, and I'm going to run these exact numbers, and we're going to see how much equity founders and the team gets left with after these standard rounds. And the reason I do this is because I think it's a useful exercise that you should run as you approach funding, I mean, raising money and so on. You can access this tool in our platform. You can just scan the QR code, or my team is going to drop the link to our cap table tool in the chat. Okay, so let me pull it up here and change my screen share. There we go. Okay. Okay. Yeah. So this cap table, you'll find it in your Slidebean platform. It's based on a Google Sheet, so it's not rocket science, but we've done our good work to make it usable and intuitive. So what we have here is the default, like the standard cap table. I'll make this a little bit bigger maybe. Yeah, the default cap table, right? So normally, if we go to founders, we establish that I'm gonna be the founder of this business, and I'm gonna have Andre be the co-founder since you were here early, Andre. All right. So Andre and I, we've decided to start this business. We decided to start it with 5 million shares each. Now, why 5 million shares? It's a number that makes it easy, or rather easy to make it divisible as we move into the future. You could do this with one share, right? You could do this one share for me, share for Andre, and if we put that in the cap table, then that's fair. We still have 50% of the company. The problem is, what if we want to give an investor not 33%? We can't, right? Because we can't split this more because we only have one share to split, right? And you can't split a share in half in C corporations. So normally what you want to do is use a big number, a large enough number that lets you do that. One thing that we could do here, for example, if we are three co-founders, one thing we could do is we could have 10 million shares and we could have 3 million each founder. So that's just a little messy, right? So one thing we could do is we could just set it with 3 million shares each, right? 3 million for each. Who's going to be the next co-founder? I see you, Anthony. Okay, Anthony. No, so I don't want to be we want female representation here. So let's have Marianne be the co-founder. Third co-founder. Okay. So yeah, 3 million shares each. Notice that this adds up to 9 million, which is not a very obvious number, but here in the cap table, we're evenly split 33%. So that's easy. Okay. So the next thing that we have to decide is, well, when we get the shares, normally that's going to be the day when we establish the company. And then the next thing we want to talk about is vesting, right? So vesting is how long is it going to take us to get these shares, right? Like, the shares are going to be assigned to each one of us, except we're not going to have access to those shares until a certain amount of time. So a typical way to define a vesting schedule is to do a 4-year monthly vesting with a 12-month cliff, which what it basically does is it says, well, if we get the shares on January 1st, 2026, today in March 25th, we don't have any shares yet because we still need to work for a full year in the company. That's called a cliff. And then that's when we're going to start vesting our shares. It's a bit of a safety mechanism if somebody leaves the company early before they've provided any value. So that's kind of the idea. So this cap table, I'm not going to get into that, but here in the settings, you can define other vesting schedules, right? So we have custom plans that you can use if you want to kind of forecast around that. And of course, the model will give you, how many shares you've vested over time. Okay, so we have this cap table now. We've defined it here as a 3 million shares each. Let's go to stock option pools. This is important, right? Investors, they want you to create the stock option pool before their money comes in. They want you to carve out some founder or common shares for a stock option pool before their investment. Why? Well, because they don't want their shares to come out of their end, basically. So let's do that. And obviously, we want to do that. So let's create a stock option plan. Let's call it the 2026 stock option plan. We have a video coming up about this, by the way, with a much more detailed explanation on how this works. But the idea is that we create a plan. We're going to approve maybe 1 million shares to this plan. And now we're going to have this even round number of 10 million shares for the company, right? And this stock option plan is 10%. And we'll create it. We'll have that plan created. They're common shares. We're going to create it in February, say the start of February, right? Or, 1 day or 1 month after we incorporate it. And we haven't assigned this plan, right? It's all empty. We haven't given these stock options to anybody. We're just kind of reserving them there. We can, of course, do that from here, and I'm just going to do it for the sake of example. We're going to hire Joseph. So Joseph's going to be our first hire. It's our first employee, right? And we're going to assign them to this stock option plan, and we're going to give them maybe 100,000 shares from that plan. Not 1 million, 100,000. And we're going to give them, planning on hire them in May, right? So again, we can define a vesting schedule for them. And when we issue these shares, they own 1%, but of course that might change as the company changes. So if we go to cap table, we'll see that we don't see it here in the plan, but if we go to the detailed version, we'll see that we have some unallocated and the ones we assigned to Joseph. These are stock options. These are not shares, right? They're not. Joseph doesn't own them, but that's a story for another day. We're working on a full video on it. If you want to subscribe to the channel, make sure you watch it. Okay, let's go to the funding rounds now. Okay, so we established that a pre-seed round in this day and age was something like $900,000. So let's do that. Let's use that. So $900,000. And let's say that we raised this in April. right? So let's see how that does. We have this placeholder valuation of 3.6 million, but let's see what that does. If we go to the cap table, we'll see that this pre-seed round translated into about 20% of the company, right? It's a big investment. It's a big chunk, right? We said that the standard was something with 7, I think. So let's actually add 7 and see what that does. So 11%. That's actually somewhat low, right, for an investor. So if they agreed to this 11%, good for you. Good for you. I'd expect it to be somewhere higher, but it's the median too. So like rounds are getting a lot bigger too. Okay, so what's next, right? So time goes by, right? We have to go and we have to create a new stock option plan now because we're about to raise the next round. It's the future now. It's maybe 2027. We're running out of cash again. We're launched and we've generated revenue. We're ready for a seed round. So we're gonna create the new stock option plan, the 2027 stock option plan. And again, investors will want you to create this before they invest. In this case, because we have now more shares in the business, maybe this plan needs to be a little bigger because we need to give, we need to be ready to, for more employees. And this new option plan is 11%. Remember that the stock option plans, they need to be purchased. So they're always, this plan is much more valuable because it was created earlier. And the strike price for these shares is smaller. I'll have to explain it now. The idea of a stock option plan is you don't give any employees your shares. They're not given to them because if you give them shares in this company, shares that these investors bought for 70 cents a share, and if you give who's our employee? Sorry, Joseph, 100,000 shares, you basically gave them $70,000 worth of shares. If you just give it to him, and then he's going to be tax liable for those. So you don't want to give them the shares. You want to give them the option to buy these shares at a certain price, which is usually the price that the shares had when they're given. In this case, something like 70 cents. Now, the big difference is that when there's a seed round, and let's set the seed round, let's raise that 3.6 million, 3.6. When there's this seed round, now investors are paying 125 per share. So the shares that Joseph got that he gets to buy at 70 cents per share, he could potentially sell for 125 per share because he's helped the business and he's helped the company grow and so on. So that's the way stock options work. But anyway, what we're doing here is going back to the cap table and just seeing, how these shares have been distributed. So notice that what happens, all 3 founders still have 3 million shares here. The funding rounds, we create a certain amount of shares for them, and we have the stock option plans. Now the business has 15 million shares. Notice that our share numbers have not changed. We still have 3 million. The difference is because we've created all these new shares along the way, now the company has a bunch more shares. Now, funny enough, if we add up all of this, we end up with 57%, which is just 1% off the benchmark that I showed you guys earlier. But we're kind of on the right track. Sorry, I want to hit 26, but okay, 56. Sorry, but this is more or less like a typical, journey, right? People don't tend to think about these stock option plans, but they are very important. They are very, very crucial to all of these funding rounds. If you want to build this business this big, you're gonna need people who work really hard, who work harder than a 9 to 5, and who are maybe being paid less and who are taking in a little bit of risk because this business isn't profitable, right? So like you want to compensate that in some way, and that's what stock option plans are for. Okay, so hopefully this is a good, quick demo and actually, again, 1% off of a standard. I'm going to share the link to the cap table again, and I'm going to ask my team, Julie, if you can paste the link to the cap table if you have. Oh, you did already. Never mind. We got it. Okay, thanks. Okay, so we got it. Cap table tool, you can download it, scan it. Again, the cap table tool is part of our suite of tools for founders, Slidebean, and I'm going to get to questions just after this quick break, commercial break. Slidebean is a platform that just helps you navigate all this stuff. We have an AA pitch deck builder, we have an investor finder, we have the cap table tool I just showed you, we have a financial model so you can run your own forecasts, and some of our subscriptions even include one-on-one time with our team, including myself. So, for example, our Accelerate plan includes every month you get one session with our pitch deck team to go over your pitch deck, your slides, your angle, how you're pitching the company, if you're creating enough FOMO. You get one call a month with our financials team to work with your forecasts and just to assume how much revenue you're gonna you could generate, how much money you would need to raise, when are you going to run out of money. These are answers that you need to have in your head before you raise any money. And it includes two strategy calls with me. The first one is a group call, so we can get on the same page. I can learn a little bit about the companies, clarify some quick questions. It's usually like an hour, and then 2-3 months after you've been working with the pitch deck team and the financials team, we'll ping you again. So we can chat again and maybe a little bit of strategy or how you talk to investors, or maybe you were already talking to investors and to how to navigate those conversations. That's all the slides I have. 15 minutes ahead of time, so a bunch of time for questions. Let's see what you guys have. Throw them in the Q&A thing for Zoom, or just you guys in the live stream. Feel free to just throw them in the chat. I see Q&A. Okay. The founder's share slide is not a little too aggressive, is in favor of third parties. It is, man, but it's the truth. It's what it is. Daniel, how long is a 900K pre-seed round typically expected to last? Great question. The typical time between rounds today, or I mean, data says the typical time between rounds in this day and age is about 24 months. I'd say that's about right. Maybe so. Ideally, you should stretch that at least 18 months, at least. Ideally, closer to 24 months, which means, which kind of starts to give you a timeline, right, of how that money should be used. Remember that let's assume that you're going for the 24-month stretch, right? That means that by 24 months, you're not going to be profitable. You'll need to raise money. So that means that 6 months ahead of that, because raising a round, by the way, normally takes about 6 months. So 6 months ahead of running out of money, you need to have the metrics for seed. And that's kind of like the math that you have to play around. So if you're raising pre-seed, you need to make sure that you get to the metrics required for seed. And at that point, you still have 6 months of money in the bank. So you can get out of the office, go and raise the next round, and keep going and doing it once again, right? So normally, hitting the milestone that you're aiming for the milestone for the next round in your path, plus 6 months is usually the idea. Can we get a copy of the financial model to work with it on a spreadsheet versus a Google Doc? No, it's connected to some of our stuff. We regularly push updates, very rarely a bug fix, but yeah, if we don't have like an offline version of it. Sorry. We use some online formulas and some stuff that requires it to be a Google Doc. Is raising less than 900K at pre-seed a disadvantage today? For example, is it easier to raise a larger round now? That's a good question. I think that the size of the rounds is very much dictated by where you are, right? I think that that's median is 900,000, right? So if a median round is 900,000 around the US, that means that a round in San Francisco, a pre-seed, is probably in the $2 million range, simply because of how expensive San Francisco is. And because there's more investors and more money. Funny enough, that same company with the $2 million valuation, with a $2 million round in San Francisco, is going to be worth a lot more than the $900,000 company outside San Francisco, right? Valuation at these early stages is kind of dictated a little bit by how much money you got to raise. Now, that being said, the round should be enough to hit the milestone plus 6 months. That's everything, right? So, for example, if maybe you run your forecast, you do your budget, you run your financial model, and you figure out that you need 900,000 to hit the next milestone. An investor comes in and tells you, "Oh, well, we're only going to give you $200,000. Do you take it?" To me, the answer is no. Like, you shouldn't take it, right? Because you just said you need 900 to hit the next milestone, and if you raise just 200, you're going to run out of money in 2-3 months. You're not going to be able to do what you set out to build, and you're probably going to lose that investor's money and your time, right? So like that number that you put in the pitch deck of how much you need to raise needs to be a very educated number. And oftentimes, if you don't investors know that if you don't hit that number in terms of how much you're raising, you probably don't want to raise at all, right? A lot of rounds, actually priced rounds, safes and convertible notes, those rounds you can actually close the checks as you move along, right? Investors are normally going to wait and see if there are other people committed. They don't want to be the only ones. But on a priced round, you actually need to get all the investors signed at the same time, right? So, if you're raising a $2 million round and it's a priced round and there's only commitments for half of that, that investor is going to say, well, no, because I don't want to invest. You said you need 2 million and I don't want to give you just 1 million. You're going to burn through it and I'm going to lose my money. Right? So that number is important. It's non-trivial what you add there. Marianne, our third co-founder. We've raised our 100K pre-seed through equity-free grants, and now we're starting to get revenue, so we want to raise the next round. And it's a mix of debt and equity. Do we still need to hit 5x ARR for the valuation? What's the next valuation metric? No, I mean, I wouldn't call this 100K pre-seed, by the way. If you raised a little bit of money from grants, I would just call that grants. I think that you're still not at the pre-seed. You said you're starting to get revenue, right? So again, I could still call your next round a pre-seed, if you will, simply because you haven't really raised a proper pre-seed in this day and age, and that's maybe an advantage. Is like you're a very advanced pre-seed company. I would, yeah, and it depends on how you angle it, right? You could say, hey, we're a very advanced pre-seed that launched and has a little bit of revenue, but we did this with just grants and we haven't shed any equity, which is I think a solid story. The other is, well, do you get to seed, right? And at seed, you're normally doing, again, like I said, 40K in monthly revenue, which translates to what's that? 480,000 in annual run rate. And yeah, like if you wanted to do multiplier of that, it would have to be like 20, right? So at that point, with very little revenue, we still don't operate on multipliers. We still operate seed rounds on some standard that investors are using. You start to get into ARR multipliers when you hit Series A and on, when the ARR is actually in the millions of dollars. How to decide and justify valuation? Kind of what, I don't know if do you want to kind of what we've been talking about. I don't know if you have something more specific about it. I think we've covered it. Do we decide how much to raise on our projected cost for the next 18 to 12, 24 months? Absolutely. You decide how much to raise, right? You want to create the smallest possible amount that you need to raise in order to hit the milestone, a little bit of cushion in the 6 months that you need to raise the next round. That number you come up with. Investors don't come up with that number. Anonymous. If we are only raising 500,000 Canadian, by the way, YouTube people, you can ask questions too. I see your chat here. If you're only raising 500,000 Canadian, will it still be a 7.1 million valuation cap and pre-seed? No, because that round valuations are always kind of tied to what the standard is, right? So less money means a smaller valuation, so that the percentage of equity that the investors get is on par, right? So if you raise half of 900,000, your valuation is probably going to be about half. Investors are still going to get something like 15 to 20%. Is this valuation for a price convertible note? Convertible note is, you put a cap on it and you put an estimation on it. But in the end, the idea is that it converts at something closer to that. We are pre-revenue. We have an MVP. We first wanted to raise 1.2 million as pre-seed, and they said it's maybe too much. But we got feedback from an investor who offered 250 convertible net and said it's too difficult to raise and advised us to go with 500. Yeah, I think 1.2 is a lot. I mean, it also depends on you, right? Like I think when you see a company that gets to raise 2 million and therefore get this double valuation compared to the company that raised 900, that's kind of connected to the fact that the founder was really well connected, right? So if the founder is really well connected, they have a lot of investors in their network. That inherently makes the company a little bit more valuable than the guy who could only raise half of that, right? So that's, I think, a factor too. Can we save as a Google Doc to work online? No, we don't use your data. We don't look at your data. You can check our privacy policy. We don't train AI models or anything or anything on that. We always assume that the people what are doing in our cap table is just forecasting anyway. So yeah, like you can check our privacy policy. We don't use it for anything, and no, you can't download it again because of the online aspect of it. Some formulas and some updates. What is the difference between priced and non-priced rounds? Why do you have to raise them together? Oh, priced and non-priced. Good question. A priced round is a round where you have a valuation defined, and that defines exactly how much percentage of the company the round converts to. A non-priced round would be like a safe or a convertible note where that valuation doesn't exist yet. It's kind of like a virtual money or a loan to the company until the next round, right? So the next round sort of prices the convertible note. We have a video about that if you want to check it out. Is there any difference in the process for startups in Latin America? No, I don't think the process is very different, except the fact that safes are less common. Investors are less familiar with that instrument. And valuations tend to be lower simply because the money that you need to hit to the next milestone is less, right? So Latin America is less expensive than the US. So you're probably looking at fractions, maybe half of the amount of money that you need between two rounds, and at the same time, valuation also tends to be smaller. That also connects like longer term. It's like who's going to buy your business. If you know if it's a company in Latin America, that company inherently has less money than a company in the US. Um, Question from YouTube. Thanks for all you do. What do you think evaluation for mobility startups in Africa looks like? We're raising at $1.5 million valuation. What's your take? I mean, that's a low valuation, but again, I'm not familiar with where in Africa you are. Africa's the whole continent. And yeah, like 1.5 million looks like a very low valuation. I'm assuming that you're raising very little money. Just make sure that it's enough to get to the next milestone, right? I would try to find a benchmark for other companies around you to see how that's operating. Could we have a recording of the session? It's live streamed on our YouTube channel, the Startup Club. You you can find it on YouTube. Just search for the Startup Club, and that all our webinars are hosted there, and they live there for a few weeks until we do another one of the same topic. Profits, interest, not equity. Thoughts? No. I mean, not for a venture capital investor. They don't want that. It's you know what's an interest rate? 10%? That'd be an aggressive interest rate. That's not it's not worth the risk, right? You get 10% with I don't know, you get 7% with a mortgage because it's safe. You can take the house, right? But when you're investing in a company where money is being spent so aggressively on people, no refunds, and the company goes bust, you need a bigger upside than interests. That's why that's usually not. And then profits, same, right? Profits just take too many years to pay back. It's not a standard for VCs. Um, how do you justify founder salaries after a priced round? Oh, good question. I've never had a lot of trouble justifying founder salaries, honestly. We started with a small salary, and as the company scaled, we scaled the salaries. Um, for me, it was always an easy conversation. Our salaries, I don't think were ever crazy or astronomical or something mad. So yeah, just enough money so that you don't have to worry about money. But also not so much that you're kind of like saving a lot of money, right? Like it needs to be just enough so you don't have to worry about money. I that's kind of like the middle ground. But no, I've never had a lot of trouble justifying it. Even at pre-seed, right? You need to pay yourself. You need to eat, right? You just can't live off air. So that's fine. You're welcome, Colin, for the thanks, Marianne, and also dual class shares. How do you get on the board to agree on this? Dual class. I mean, anything that is not just common shares is complicated, and anything that's complicated is complicated, and anything that's complicated is expensive, meaning that in legal fees, it's harder to understand. You know, as new investors come in, they have to understand the different classes and read through more paperwork and so on. So we have dual class shares in Slide B now. Our round converted to some preferred shares that had a liquidation preference. Um, we had raised the convertible note that eventually converted to shares with a liquidation preference. So we have those two classes, but it sort of responded to necessity, not to us founders trying to be smart about it. Is kind of what I thought. Yeah, I wouldn't overcomplicate things unless it's necessary. Um, Founder shares, if you can get them to be common shares, then that's even better for you, right? You're all in the same boat. Investors are probably going to prefer some form of preferred shares with the liquidation preference. That's normal, which is not great for you. But I wouldn't create separate classes of shares for the team, say, or for the founders. Yeah, that'd be weird. Is it normal for a seed round to be priced? Yeah, perfectly normal. Sorry, it's almost 11. I don't have a hard stop. Yeah, I can finish these questions. Don't worry. Okay, do you have any numbers and suggestions regarding law firms at this stage? Um, Clarity, I'd say, is the best one. It's like a group of law firms, but they're actually pretty good. They understand. Clarity law firm, is it? Did I get it right? Law firm. No. Oh shit. I'm drawing a blank now. There used to be one. I can't remember what it is. I'm sorry. Send me a tweet and I'll tell you. I have to look it up. Okay. What would you recommend doing if company raises some capital through saves but are unable to reach their total target fundraising? Keep fundraising, adjust and work with what you have. Yeah, I mean, there's a point where you have to give up, I suppose, in fundraising. Um, I mean, I think that I hate fundraising, I think the shitty part about it is that you are away from work, right? I like product building, I like marketing, I like growing the company and running the business. I don't like having to deal with investors and convince them and get kicked out the door most of the time. So, so yeah, like I don't love fundraising. Like there's only if things are slowing down, if the excitement is cooling off and you've already have some money in the bank, then maybe adapt to that. Just remember, it's odd to raise money between pre-seed and seed, so you're gonna have to use this money to get to the milestone. That's probably gonna mean readjusting your expectations very drastically about how much money you can spend. Yeah, don't assume that you'll be able to raise money before the next round. I think that's a mistake that a lot of people make. Maybe you get lucky, but it's not the standard. And again, if you go out and fundraise again, that's another 1, 2, 3 months that you, as a founder, need to step away from the business, which is also dangerous. How about Canada? What is the pre-seed valuation cap? Man, I'm sorry, I don't have like Canada, Atlantic region specific numbers. Maybe PitchBook or Carta have some. I think the numbers I shared are standard US. I'd say Canada maybe a little bit a percentage lower than the US. Not 1%, but some percentage. Founder salary can be decided internally by board or need to be approved from major investors. No, just the board can decide it. That's what's great about a board. You don't need to go to everybody to get it. Investors don't want. They're not great at running businesses. They're usually wealthy and they don't want to be distracted by small stuff. A founder salary, as much as it defines your life, is small stuff for them, right? As long as you're not paying yourself, I don't know, $300,000 a year, uh, then yeah, it's not gonna be a big deal for them. So no, all that stuff. That's what the board is for. Um, we got the Canada question. How much is the typical founder salary in pre-seed level? Man, it depends a lot on where you live. Founders, of course, are the builders. I mean, that's the expectation. But of course, I mean, this is based on your runway, right? You need to estimate this in how much money you have so that you don't run out of money. I've seen founders. I'll give you some examples. I've seen a founder in their 40s pay them in New York pay themselves pre-seed somewhere in the 70, 80K right in New York, which is it's an okay salary as they were doing well. I think they raised their seed and it was a multi-million-dollar round. Maybe they grew their salary to I'm sorry, to 150, right? Which is again not a crazy salary in New York, but comfortable salary. And then when the company started struggling, runway was running low. They were not a lot of progress in the round, about to run out of cash. He cut his salary to something like 30. So yeah, like you see that responding a little bit to the company too, and the moment in which the company uh, is. Okay. Right. Daniel from Costa Rica, question on the Still Living Starter Plan. Do you have access to these templates? I think you have access. I think you do. Yes, I think you do have access with the starter plan. The biggest advantage of these accelerated plan is time with our team. Like the reason why accelerate is 99 a month versus our starter plan, which is $12 a month, is because it includes time with our team for stuff, right? Time is people, not AIs just yet. Um, when you've invested a lot of your own run money in paying for your own runway, can you get that back? No, that's a good question. No, you don't raise money to pay back what you invested in the business. Big mistake I think founders make. If an investor sees a company and realizes that it has a $300,000 withstanding debt to the founders for money that the founders put in, they're not gonna want to take that deal. They're not gonna want their money to go to the founder. It's expected. We're all expected to spend a little bit of money to build the businesses within our own means, and it's not expected that that'll be paid back. important. I think a lot of founders expect that. I expected that in my first company, and we never raised money, so I just ended up with debt that I had to pay myself, which sucked. Uh, so no, don't do that. Don't do that. Learn from me, from my own mistakes. Ba, ba, ba. What's your advice on completely bootstrapped startups? Maybe this will be the last question I have to run, but um, I think that the idea of completely bootstrapping is very sexy, right? It's like, oh, I don't have to take investors. I'm just going to be on my own and make my own decisions and whatnot, right? So that's cool and exciting, right? I think the problem with bootstrapped, especially today, I'll give you a little story since it's the last question. When we at some point we Slidebean decided to build another product. We came up with this idea for a product called Recurring, which was supposed to monitor your SaaS platforms. And we carved out a little bit of the team. I think it was one engineer and one UX designer that most of the time they just did that. You know, while the executive brains of the organization, let's say my co-founders and I, were still focused on growing the main product and so on. What happened with that was, I think, a perfect example of why bootstrapping is dangerous or not as sexy as you might think is that by the time we finished that product, which was 6 months later, we hadn't talked about it or anything. About 5 new companies that were trying to solve the exact same problem popped up. Again, I'm not saying nobody stole our idea or anything. It's just I think it was a good idea. I think it was a problem that a lot of companies were experiencing, and other people figured out that they also take a stab at solving this predicament, right? And they did, and they raised money for it, right? So suddenly we found ourselves with a product that we were bootstrapping, air quotes, right? Bootstrapping. We have not raised money in a while. We were bootstrapping this product for our, with a little bit of time and from the revenue that the other product generated. Um, so we bootstrapped this thing, and by the time we had it ready, it was too late, right? Somebody had beat us to it. And I think that in this day and age, with AI and uh, agents and vibe coding, it's very easy to be outrun on a product, right? Very, very easy. Um, you can't if you want to be company two, there's no way you can bootstrap it. You can bootstrap a company one, and it'll always be a little small, and I mean, I think if it's software, it's gonna be very sensitive to the market, right? Somebody might build a competing product, and you might steal your boat, might steal your lunch. Um, but yeah, I think that with if you want to build bootstrapping has that danger, and I think that it's less sexy. I would still rather take investment and make it or break it in 2, 3 years, right? Like than having a 10 years stretch bootstrapping a product that I know is going to be slower simply because I just don't have the money to grow it faster. Yeah. Okay, guys, this has been such a great session. Um, I so many great questions. You took me down memory lane. Mohad is asking on that story, how did they know that they beat me to it? Yeah, we tried scaling. We had the YouTube channels. We had marketing. We had a platform to scale. We had thousands of users we could push it to. It's just that the other products were better, quicker because they were recently funded and they had a bigger team, et cetera, et cetera. So yeah, it's not just scale. It's not just growth budget, right? It's not just growth hacking. It's the product that you can build with $0 and bootstrapping and $900,000 on a pre-seed to burn through in a span of 2 months. Like, you can build a much better product objectively, right? Objectively, you have more flexibility. I'm not saying don't bootstrap. I mean, if you want to do it, by all means. It's just like I think you have to understand what type of company you want to be. All right, guys, this has been really fun. Thank you for stayed all along for an hour and 10 minutes to hear me blabber about all this stuff. We have another webinar coming on next week. Whenever you discover this one, you should probably have the information for the next one. I think it's going to be Monday or Tuesday. I can't remember right now. Catch you on the next one.